This is video 1 of a question combining IFRS 9 with IAS 8 and specifically debentures of IFRS 9 together with IAS 8. If we look at the given information, on 1 October 2013, Matilda Limited issued 10, 12%, 5,000 Rand debentures to Singita Limited at the fair value of Rand 47458 and received the amount in cash. So a few things we just need to note. The first one is we are working with Matilda Limited. They are the issuer of the debenture. In other words, they will have the financial liability. How many debentures did they issue? 10 debentures. What is the nominal value of the debentures? It's a 5,000 Rand debenture. What is the nominal rate of the debenture? 12%. Remember, the return that Matilda Limited will have to pay the investor, in this case Singita Limited, is interest that will flow in cash. How do we calculate that cash flow interest? Nominal value times nominal rate. So the nominal value is 5,000. The nominal rate is 12%. That 12% is always per annum, per year, unless we very specifically say something else. Does that mean the interest will always only be paid once a year? No. We calculate the amount for the year, nominal value times nominal rate, but that interest, that cash, can flow every month or maybe 6 monthly or every quarter. It doesn't need to be once a year, but the total for the year can be calculated as nominal value times nominal rate. And remember, in this example, there was not only one debenture issued, there were 10 debentures issued. Something important to see is that they give you the fair value. So you do not need to do your calculator calculations where you take the future cash flow and discount it back to PV to get the fair value on initial recognition. They give you the fair value. They tell you that these debentures were issued at the fair value. That does not always need to be the case. You cannot assume that the issue price is fair value unless, like in this example, it is very specifically said. If we read on, it says on 1 October 2013, transaction costs of 2,500 Rand were incurred and paid for in cash by Matilda Limited. What are those transaction costs again? Well, Matilda Limited could have paid a broker or maybe a lawyer to draw up the debenture contract. This is an amount of money that is paid to a third party. It is not cash that flows between the issuer and the investor. The investor can also have transaction costs. They could also have used a broker. It is possible that both the issuer and the investor can have transaction costs. That doesn't need to be the same amount. It's not an amount of cash that flows between the investor and the issuer. If you continue with the information, the market-related interest rate on similar debentures is 15%. The debentures must be repaid by Matilda Limited to Singita Limited once off 30 September 2018 at a premium of 10%. Remember, debentures are redeemed, they mature, they need to repay the cash to the investor. It can happen once off on a specific date, or it can happen more than once. In this case, it will happen on 30 September 2018. A redemption or a maturity payment can either be at the nominal value, it can be higher than the nominal value, then we say it's at a premium, or it can be lower than the nominal value, then we say it is at a discount. In this example, it is at a premium of 10% on the nominal value. Interest is payable annually by Matilda Limited at the end of the period, 30 September. Matilda Limited did not designate the debentures as measured at fair value through profit or loss. The default category of financial liabilities is at amortized cost. However, there are times that the entity that has the financial liability can designate the liability as measured at fair value through profit or loss. So this sentence is important so that we categorize the financial instrument correctly, because initial and subsequent measurement depends on the category. They then go on and say, Matilda Limited has accounted for this instrument up to 30 September 2015 as follows. They provide you with the journal entries. The first entry is on 1 October 2013. That was when the debenture was issued. Debit bank, because Matilda Limited is the issuer. They receive the money from the investor. Credit is the debenture liability. It is a liability because the debenture needs to be redeemed. The money at some point needs to be paid back to the investor. The amount has to be, in terms of IFRS 9, at initial recognition, the fair value. In this example, the fair value was given. We did not need to go and calculate the PV by discounting all the future cash flows. Journal number 2. Debit transaction costs, credit bank, 2,500. If we then have a look at the journals, both on 30 September 2014 and 30 September 2015, it is the interest journals. No repayment yet because the debenture is redeemed or it matures once off and not at the end of 2014 or 2015. So how do we calculate the interest in each year? We do it on the effective interest rate. What does that mean? It means we take the balance on the debenture T account times the effective interest. So balance times a market-related rate. So first, add the interest onto the liability. Second journal for each year, recognize the payment of the cash flow. Credit bank, debit the debenture liability with the cash flow. How do we calculate the cash flow interest? The cash flow is nominal value times nominal rate. If you have a look at 30 September 2014 and we look at the cash flow journal, it is the nominal rate of 12%. The nominal value, be careful, it was not only one debenture of 5,000 Rand, there were 10 of them. So what is the total nominal value? Times the nominal rate. That is the cash flow interest. That cash flow amount will stay the same if there is no redemption, no maturity payment. As long as the full nominal value is still outstanding, the interest will be the same every year.